mutual funds do not last long. In such scenario, is it advisable to go for SIP for a long time?
Okay, so good question. So if you look at India, there are more than 40 asset management companies. And what you will see even going forward is some amount of consolidation in the mutual fund space. When I say consolidation, maybe some of the bigger asset management companies may buy out smaller companies. Variety of reasons, viability could be an issue. But whatever happens, I think from an investor perspective, please understand that mutual funds are created by way of trust. So there is a trustee that is appointed or the trust company that is formed, who are the sort of guardians of the investors. Now, irrespective of what happens to a company operationally, every investor is safeguarded by the SEBI and the AMFI, okay, which says that in the event tomorrow, let's say there's a hypothetical company ABC, which gets wound up because of operational inefficiencies, whatever it is, and you as an investor that invested in a scheme of that fund. So SEBI mandate says that that company has to be acquired by some other company, or it has to get merged with some other company. So this is what is mandated, which means no asset management company can sort of take money from the investors and they can siphon off this money. So that's number one. Two, there could be some operational challenges whenever that migration from one scheme. So let's assume that XYZ company has acquired the ABC company. So the schemes of ABC company will have to be either merged with what is the existing scheme in XYZ. If they don't have, they may retain that scheme. So whatever that operational things will happen, will happen. As an investor, you will not be in a position where you will have to face a lot of uncertainties. That is guaranteed from SEBI. Returns are not guaranteed, but the fact that a company, if it is not doing well, can get acquired, can get merged, all these are options that are available. And therefore, please remember, mutual fund is a highly regulated market. It's a highly regulated market. SEBI is the watchdog. Trustees in the companies are supposed to submit every 6 months a report to SEBI confirming that everything is fit and fine in our organization. So from an investor perspective, you should not be worried about what can happen to an investor or the units or the investments you have given to a fund. What you can reasonably be worried about is what can be the volatility in the returns or the fluctuations, and that is where over periods of time those also get sorted out. I think to cut the story short, regulated market, okay, asset management companies, nothing will go wrong. Even if something goes wrong, your schemes will get shifted, and that's the only window period or time period, where you might be a bit worried as an investor, because those things will take time operationally, maybe 3 to 6 months, for all those schemes, renaming, etc., etc. And even as an investor, if certain things are going to happen, you are given a choice to exit from that investments. Okay, so that's again a SEBI guideline that investors will be given the option that either you want to continue with that or you want to exit. You can exit and come out. So all those things are available as possibilities, which you can explore in the event something goes wrong. So don't worry about investments. Look at it from a long-term perspective. I think there's nothing to be worried from a regulation perspective.